Well, a good portion of the nation is still in lockdown, and as you can see, this is my lockdown hair. We can't get a haircut at the moment here in Auckland. We're hearing about the inflation rate surging at the fastest pace in the last 10 years in the last third quarter numbers that were released. And you probably have seen on the news that interest rate is on the rise. Is it still a good time to invest in properties? Now, to answer that, we need to understand three major influences in the property market. And we're going to break them down into three videos. In the first part, we're going to touch on monetary policy, which affects the short term of property demands. The second major influence is housing supply, which influences the house price in the medium term. And thirdly, the long-term influence, which is the population and economic growth. And at the end of each video, I'm going to be sharing with you a little bit about my thoughts on the current market. And if you find value, don't forget to smash the like button for the YouTube algorithm. So firstly, monetary policy. What is it? It's the Reserve Bank of New Zealand's ability to influence the demand for goods and services. Simply put, they will want to make you buy more stuff, or they will want to make you save more money. The goal of that is to bring stability in the economy. And one way they can do this is actually turn the dial on the official cash rate, which influences the interest rates on our mortgages. Lower interest rate, we spend money. High interest rate, we save money. And short-term demand for properties have a high correlation with interest rates. If investors can borrow for cheaper, then they will borrow more to find investments that will give them a higher return. And for the past 12 months, interest rate has been hovering around at that 2.5% rate. This puts almost all property in a cash flow positive position, meaning as soon as you buy, the rent is going to cover all of the expenses plus the mortgage. And if you can borrow at 2.5% and invest in a property that has a 4% cash flow, why wouldn't you? The other way the Reserve Bank of New Zealand can influence the demands of goods and services is through printing money. No, it's not putting the $100 bill in your photocopier to print out more money. It's just slightly more complex than that. But if I could simplify it, it's just to put more money into the economy so that there's more money circulating. They usually do this to gain consumer and business confidence when there are signs that the economy might slow down significantly. With more money circulating in the system, people are more willing to spend money, or in our case, invest in more properties. However, you got to keep in mind, by printing money, it actually makes the dollar worth less than what it was yesterday. So it might cost $1 to buy a bottle of milk yesterday, it might cost you $1.20 in the future. And when we print money in the medium term, it induces what we call inflation, or increase in the price of goods and services. And circling back to our first point, the monetary policy is actually used to bring stability in pricing and in the economy. Now, this was not the case recently. When we were going into the first lockdown, we expected the economy to slow down significantly. Hence, many central banks, including Reserve Bank of New Zealand, decided to inject more cash into the economy. Again, trying to boost the confidence for consumers and businesses. Now, did the economy actually slow down in a massive way? For some industries, yes, notably hospitality and tourism. But for many businesses, they actually thrived during lockdown. We saw massive growth in the tech space. Even banking are using a lot more technology now. Online shopping and consultations that could be now done on Zooms. So the result of the money printing. Basically, there are too much money circulating in the economy now. They were not exactly distributed evenly. And there are some major side effects as well. If you pair this with historically low interest rates, it will cause major surges in asset prices. Properties, cryptocurrency, shares all saw historic gains. As the asset prices go up, people feel wealthier, they can sell some of these assets and they're more willing to spend. And of course, if they were to buy in the same market, they would start paying a higher price as well, which all contributes to the increase in all these asset prices because there's so much more liquid cash going around. So in summary, all the world leaders thought we might go into a depression due to COVID. So they started prescribing the economy antidepressants. And to get quicker hits, we actually started injecting it like it's no tomorrow. However, it didn't take too long for us to realize that we are severely overdosed. Asset prices have skyrocketed. Many property owners became instant millionaires and made even more crypto millionaires in the process. Now the leaders are actually trying to do everything to reverse this. You have seen tons of regulation changes for property investors to make it harder, and interest rate naturally will have to come up to try and slow down the market. So what does this mean if you're thinking about properties? The long story short, cost of goods and services goes up, interest rate follows in the coming years. And historically, what has been a good hedge to inflation? Properties. Now, property returns has historically sat above inflation rate. So that means when inflation is high, property prices will go up even higher. In saying that, where's the risk? Because interest rate's going to be rising, cash flow is going to be far more important and is going to be the biggest risk in properties. So it's actually super important to bring on cash flow positive debt. Meaning, if you were to buy a rental on leverage, you would want to have the cash to cover the rent and more. So in case if the interest rate were to go up, you still have a little bit of a buffer. So if you're looking for lower cash flow property with high capital gains, then you would want to put more cash into the deal so you can control the level of debt that you're getting on that property and making sure there's a surplus cash flow so that you are looked after if the economy goes in a worse position. Now, if you need to buy a property at 100% finance, then you would want to buy a property with very high cash flow. These properties might be the multi-units or even a mini development where you could put a minor dwelling to increase the cash flow position. And as always, if you were to take on an investment property, you should increase your revolving credit facility so you always have a buffer that will allow you for the vacancies. So there you have it, folks. Hope you guys have found value, and if you did, remember to smash that like button for the YouTube algorithm and subscribe if you want to watch the second part of the series on the housing supply. I'll see you guys again.